First session today is one of the 2 top session proposals ranked by the CFO advisory group. Increasing fee income without raising fees. It's one of our biggest challenges as CFOs, non-interest income, right? Our presenters are David Furness of Haberfeld's CEO and Vicki Petit, one of 3 conference speakers today who is a current bank CFO. David Furness is a former community banker and as a CFO and a COO. He ran the largest division of Alex Sheshinoff's management services prior to joining Haberfeld. Vicki Petit is the CPA and has been the Chief Financial Officer for Vision Bank, headquartered in Ada, Oklahoma, for 27 years. She began her banking career after working for 12 years in public accounting and insurance. She was appointed by the governor of Oklahoma and served 10 years on the Oklahoma Accountancy Board. Would you please welcome David and Vicki?
Good morning. How's everyone this morning? Very good. Well, I'm David Furness. I'm with Haberfeld. Getting a little reverb there. I don't know if we can turn that down just a touch. So my role at Haberfeld, I do realize I'm presenting to a group of CFOs. My role at Haberfeld is overhead, so I want you to know that right from the beginning. I do a fair amount of public speaking, and one thing you should know about me is I'm a collector of quotes, and the first quote is clearly the most important. Roscoe Drummond said, "The mind is a wonderful thing. It starts working the moment you're born and doesn't stop until you get up to speak in public." So you'll remember that as you extend a lot of grace to Vicki and I today as we do this presentation. So the ABA asked us to put together a presentation, increasing fee income without raising fees. And so as sort of an initial backdrop, just thought I'd pose some questions, rhetorical questions about, if we want to increase fee income, how do we do that? Do we raise fees? Obviously, you bump up fees on stuff we already charge for. Does that work? How much does it work? Is there any elasticity of demand in some of the fees that we charge? So we'll talk a little bit more about that as we go. Charge new fees that we haven't charged before. We've kind of been there, all of us, right? And so that doesn't seem to be a well that will produce very much. Third, get into some new areas where we can grow fee income. That may work, maybe an opportunity in particular for larger organizations. But outside of that third bullet, excuse me, do any of those really materially increase fee income? Our experience is generally for community banks, it doesn't. And so when we think about growing fee income, we actually think there's a much simpler answer for community banks. And that's what Vicki and I are going to spend this morning's session talking about. So I'm going to start with a very bold statement. I'm biased doing what I do. I've been in the industry for 35 years now, a former CFO, but I've worked with community banks, over 1,000 community banks around the country. And so I say this, even though it's a bold statement, with a lot of passion and experience. I think that 7 out of 10 of you in this room today can materially increase fee income. Not a little bit, a lot over time. And you can do it in a way that's very, very profitable. But it requires dispelling some conventional wisdom that exists, and in particular, wisdom that's become more and more prevalent post-Great Recession. So we're going to talk about that. I think the market's changed, but a lot of community banks haven't. Doug Larson said, if we do that, accomplishing the impossible means only that the boss will add it to our daily duties. All right, so current landscape backdrop, as you guys know, our industry in terms of number of units is consolidating. So, and it's consolidating at a fairly decent pace. If you look back just a decade, there were about 17,000 community banks and credit unions. And if you look today, it's somewhere around 12,000, 12,500. And if you'll notice, it's the smaller institutions where the bulk of the consolidation is occurring. Those that are over $1 billion in assets have actually not shrunk in both the banking and the credit union side. So we have this pie, this customer base in the country that is being serviced by a declining number of financial institutions. Also, we're seeing a consolidation of the country's assets, deposits, transaction-based deposits, into larger institutions. And by the way, if you look at that graph, it's very interesting to me. During the Great Recession, with tremendous angst about the big banks, right? Everyone was on the news all the time railing against the big banks. While that was occurring, they were gaining market share. So we've got this phenomenon today where the top 30 financial institutions in the U.S. control about 60% of the deposits. And all of the rest of the institutions are fighting over the 40% share. They have the 40% share. We think there's an opportunity to take substantial market share over time from both pieces of that pie, both the larger institutions that have 60%, and then win more than our fair share of customers and core deposits out there. So we've got this barbell effect happening. Joan Rivers said, I told my mother-in-law that my house was her house, and she said, get the hell off my property. So that's what's happening to us a little bit. All right, good news is loan-to-deposit ratios are growing again. You guys are seeing this in your financial institutions. As I go around the country and talk to banks all the time, we see it as well. There's more optimism, and we've sort of hit this inflection point recently, within the last year or so, it seems to me, where I've really felt it as I've interacted with you all across the country, and that is, after the Great Recession, we were all awash in liquidity, right? And we had a balance sheet that was in pain, and that was the focus, but we had more core deposits than we needed. Interest rates were incredibly low. The money had no value. It had no place to go. It parked on the sideline in a very safe place, community banks. And so loan-to-deposit ratios, as you can see, declined. What we've seen in the last year or so is you all are seeing loan-to-deposit ratios grow, and as rates rise, now there is this desire again for core deposits, for funding. We need funding to keep up with that, and that's become a strategic issue for you, the community banks across the country. So for a while now, that worked a little bit. For a while now, I've been saying at conferences like this that we'll get to a point where we'll hear something of a great sucking sound as deposits have some place to go, and the community banks across the U.S. need core funding again. And so as the guy is looking into the vault here and seeing it somewhat empty, community banks are at a point where they're saying, hey, we need core funding. And so this is a particularly good time, I think, to talk about this topic, and in particular, the way that we view, at least, how to address this topic of increasing fees, increasing fee income. So cost of funds are obviously on the rise, and they're on the rise pretty dramatically. You, as CFOs, you certainly are tracking that and chartered with what to do about that. So you're feeling it better than any group in the country. But it's costing us a lot of money, right? And the question is, what are we going to do about that along the way? The importance of non-interest income, very, very important to us. Something around a quarter of our profits are derived from NII, so this is a very strategic issue for us. This is one of those charts that's no fun to look at. If you go back to pre-Great Recession, right as the Great Recession started, and use that as an inflection point for one metric on the FDIC data, service charge income on deposit accounts. And you look at what's happened since then, this is what's happened. And it's not a pretty picture, right? Service charge income on deposit accounts, for those that are over 10 billion, the orange bars are down 40+%, almost cut in half. And for smaller institutions, those under 10 billion, it's down 30+%. So you guys have felt that. Now, one challenge I want to provide to you along the way here today, and you may not agree with this, and that's okay, but I'm going to make this point a couple of times in my presentation, is when things like that happen as a backdrop, as institutions, we begin to make some decisions, right? And I want to challenge us that times are changing again, and some of the decisions that we made post-Great Recession may not be the right decisions now again. And it's time to revisit those. So I'll talk about those a little more as we go, and Vicki will certainly spend some time on that as well. One of the drivers of this is NSF/OD income. As we know, Great Recession, we had Reg E opt-in and a variety of different things related to NSFs and ODs. So this is our client data. We actually get data from clients on a monthly basis. It's in excess of 10 million products and services, a very robust database to analyze. And what you'll see is NSF frequency across that database, meaning the number of NSFs presented per average customer per year, has fallen from a high of about 5 across the database to a little north of 3. So substantial decline there in average presentations, if you will. Regarding overdraft regulations, this is an area that it does appear to us has shifted somewhat. There was this cloud, I'll call it, when the CFPB was created. None of us knew what that would mean to us and what action they would take on a number of fronts. NSF's ODs were one of those. They have a rulemaking agenda, a calendar, if you will, and that had been on their agenda from the very beginning, and it had just continued to move down the road in terms of dates that they anticipated addressing it. So it was this, none of us knew what they were going to do, right? One of the things that was proposed was potentially capping the number of fees a bank could charge at 6 per year in any rolling 12-month period. That was one of the notions that was being kicked around. With Mulvaney taking over at the CFPB, in our view, 2 key things have occurred in public pronouncements. One is overdrafts are no longer on the rulemaking agenda. So that seems to be at least less unknown, if you will. Rules aren't going to shift on us yet again, it would appear, at least not in the near term. And secondly, this notion of UDAP with the extra A, Mulvaney said, hey, Congress, you guys define this notion of abusive, but you didn't define it at all. We would actually like some guidance. You want us to regulate, but you've just used a very broad term that's subject to lots of interpretation. Please define it for us. So from our perspective in looking at this, at least for the near term, it doesn't appear we're going to have any new rules with respect to NSF/ODs in the near term. This is a really interesting slide as we look at this database that I was just telling you about. And so let me kind of define it. If you look on the left, that is NSF frequency. The y-axis is NSF frequency, and the x-axis is NSF fee, the actual fee that institutions charge per occurrence. And so we're talking about increasing fee income. One of the things that CFOs will propose from time to time is, hey, we need more fee income. Should we raise our NSF fee? And when we look at this database, institutions that charge the lowest fee actually make the most money. That's kind of counterintuitive. Now, so the question I propose in the title of that is there elasticity of demand as it relates to NSF/ODs? Now, let me explain quickly. In no way do I think that is a variable that's isolated, right? I would say that institutions that charge lower per occurrence fees tend to be friendlier, if you will, in how they think about NSF and ODs. And conversely, I would suggest that those that charge the highest fees in the market tend to be less friendly. So I don't think that variable is isolated in and of itself. I think there are other variables that go along with that. But one takeaway when I first saw this data as a former CFO that I would have had would have been, if I were thinking about raising my NSF fee to increase fee income, this would have at least given me a little pause about doing that into what its impact would be over the long haul. So interesting stat. All right. I put this slide together, my team did, just to make a point. I'm going to make the point that there is a a dynamic that exists for a community bank that in a lot of our analysis is largely ignored. And I'll make that point strongly here in a minute. But an exercise that I think is really helpful is to make some assumptions. And we can look at and debate these assumptions all day long. That's not the point. The point is the relativeness of these numbers. So if you begin to think about, we've got to grow core funding. That's one of our issues. We'd like non-interest income, fee income. We'd like to grow that. Then we think it's a really valuable exercise to say, on average, what does a typical customer produce? And when we do that, and we make these assumptions, so the fee income's actually really easy. It just is what it is, right? We have NSF income and debit card interchange income. Those are two key drivers of non-interest income for the majority of community banks. That's pretty straightforward. But then make some assumptions on what the deposits are worth and what the loans are worth at a household over some period of time. It's the relativeness of these numbers that I care about. So what we see is in this, we had this wonderful dozen years in banking back pre-Great Recession where everybody was making really good money. And then we had the Great Recession, loan demand went away, money had no value, and because of regulatory changes, non-interest income, fee income was declining. And so my point is in that middle section there, many of our institutions made decisions. We made decisions about pricing. We made decisions about product. We made a lot of decisions that impact a lot of things. And my argument today is going to be that the market is shifting now. Many of you are in a different place, and many of those decisions need to be revisited, I think. So that's one of the points I want to make is we're back to a point, yes, we don't have as much fee income per customer on average, but the value of customers are higher than they were just 4, 5, 6 years ago. All right, so how do we think about growing our customer base as one strategy to increase fee income? So conventional wisdom, I think we do fantastic analysis in our industry. You as CEO or CFOs do a great job. We look at fully allocated costing models. We come up with some numbers. You pick the numbers. Hey, when we look at customer profitability on average, a customer fully allocated costs us $300 a year. Good analysis. Question is, what do we do with that analysis? When we get that analysis firmly implanted, implicitly our organizations begin to make a number of decisions about products, about marketing, about targeting, right? We get this notion implicit in our organization that we need to get customers that provide at least that level of revenue to cover their costs. And again, we begin to make a lot of decisions with regard to that. So we're going to contend that you've got lots of opportunity to grow, significant opportunity to grow. But in order to do that, we've got to open the doors wider. And so when a lot of community banks think about getting the doors thrown open, this is what they think we're going to get in, right? That's our fear. So we're going to get the dregs of society. But in practice, our experience is working with lots of community banks across the country, it's actually very difficult for a community bank to materially change the profile of customers they can attract. That's actually really hard to do. Said differently, you made decisions about where you operate, and what you can do very successfully is get a lot more of what you're getting already, but by and large, they're going to look very much like what you're getting. Average balances, household averages, loans, fee income, attrition rates, average life. It's very difficult to change those profiles. So let me give you one example. And I promise you this is a point in the presentation. Vicki will back me up in a minute, and she'll have credibility. But this is a point in the presentation where it's going to sound like to you that I'm telling you to pour gasoline on your head and light your head on fire. So one of the things that the majority of community banks do, in fact, let me see a show of hands. How many of you use e-funds or check systems or pull credit reports, some kind of screening? All right, the majority of the hands go up. Does that work? Have we actually analyzed whether that works or not? So here's what, screening systems were started in the 70s when NSF income was immaterial, right? And today it's a $40 billion revenue source for the industry. And is the risk profile the same? So let me give you some data. I have a wonderful AB data set with an excess of 10 million accounts, half of which use a screening system and half of which don't. So let's look at those two big data sets and compare them. And here's what they show. Those that use a screening system, the NSF frequency was a little less than 3. Those that don't use it, their average NSF frequency was 3.5. Again, that's not just a single element in isolation, right? That's a theory, it's a practice, it's a way we think about bringing in core customers. So principal losses are a little higher, so it does save you a little in principal losses, about $4 per customer per year. Net fee income is actually then higher for those that don't use them, and the key variable that's just ignored is those that don't use them actually bring in substantially more customers. So does it work? My look at the data says, and I hired it when I was a CFO. I thought, hey, a filter makes sense. Let's keep the bad out and let the good in. The data would suggest it may not be working like you think it does. So it's something to look at and consider. So as I mentioned, it's pretty difficult to change the profile of your customer base. You're able to get a lot more of what you were getting before. And so our view is we think that's a really good opportunity to grow fee income is by getting more core customers. So I hear a lot, well, wait a minute, unprofitable customers will clog my lobbies. So forgive me, your lobbies aren't clogged. Most of the time I could fire off a cannon and not hit a live customer, right? And it's getting worse. Transaction volume in branches is declining, correct? So we've got lots of this. The hidden thing that we don't address as CFOs often is capacity. I'll come back to that in a minute. So your lobbies aren't going to get clogged. I would suggest to you the majority of you could double the size of your customer base, and within your footprint would not be a material issue for you to service. There is no perfect filter, both on weeding out on the front end as well as another notion that has evolved post-Great Recession is we've got to get the perfect customer, right? No perfect filter there. And so what we think the industry focuses a lot on is how many of our customers are unprofitable. And so here's a provocative statement I'm going to make to you today in the context of this discussion is you want as many unprofitable customers as you can possibly get. And I do realize I'm talking to a group of CFOs. You want as many as you can possibly get. Why? Because when you make strategic shifts in thinking in this area, you may double the quartile that's unprofitable, but you will also double along the way the top quartile, you'll double the next quartile down, and you'll double the next quartile. You'll get customers in about the same ratio in terms of profile that you're getting today, but you can get materially more of them in about the same ratio you're getting today, and that's how you can double fee income. If you can get twice as many core customers, core funding will happen over time, and you can double fee income along the way. And Vicki's going to talk a lot more about that and her experiences at her bank in Ada, Oklahoma. So doubling, really, yes, absolutely. First, you have to understand the dynamics. If you look at the markets that you play in today, they are effectively fixed. Terrible news is you can't get anybody to switch. What you can do is get more of them to pick you. Again, Vicki will talk more about that. Okay, we tend to think as CFOs about macro measurements, ROA, ROE, NII, those kinds of things. We don't think like people that run factories. What does it cost us to produce a widget? And what do we make in marginal revenue by selling one more widget? We don't think in those terms, but we think there's a benefit in doing that. How utilized are your factories? So let's dive into that. Revenues per widget. If we can get one more customer than we were getting currently at run rate, what do they throw off in revenue? And what do they cost in marginal costs? Our experience at community banks across the country is marginal revenues from one more core customer are many multiples of marginal costs. So the filters are not the answer. Raising fees, individual fees, are not the answer when we have tremendous excess capacity. So that's the often overlooked dynamic, is we think community banks build really expensive factories that they call branches, and then they run them at, pick a number, 25% of capacity, 30% of capacity. And when we do all of our profitability analysis, we ignore that dynamic. So if you add one more PFI customer, what does it cost you? So we've got to send some of them a debit card, do a paper statement for some, a little more data processing. Our clients report costs, marginal costs, somewhere in the $30 to $50 per customer per year range. Marginal costs are actually pretty low. So what do these customers look like at a typical community bank? Well, at the household level, they have 1.5 checking accounts with 4,700 in balances. Half of the households have a savings account. So when you go down here, 2.5 products, 17,000 in deposits, 9,500 in loans. When you look at the business side and aggregate those together, almost 4 products, 63,000 in deposits, 77,000 in loans. Those look pretty profitable to us on average. We can make money if those are the averages. And so I won't go through all the details here. Make some assumptions on cost. You get the fee income's about $150. Make some assumptions on rates for what we can do with those deposits and loans, and you come down to a contribution of about $250 at the checking account level when you add the cross sells. So that net present value, they stay for 8+ years, 9 years. Net present value of a new PFI customer is almost $3,000. And the net present value of a business customer is over $9,000. Lots of opportunity. So here's the distilled math, probably the most important slide in my portion of the presentation. The distilled math is this. When we look at community banks, the average community bank will invest about $200 to get one more than they were getting at run rate. That customer will throw off $300 to $500 per year in marginal revenue, and they'll stay for 8+ years. Boy, that looks profitable against a backdrop of tremendous excess capacity. And businesses in excess of 9,000. So if we can produce more widgets, if we can service more core customers, long-term, low-cost core funding, and fee income will double along the way. So it's not about increasing the fee income per average customer in our view. The strategic answer is getting a lot more core customers, twice as many, that provide the same average fee income, and we can double fee income along the way. So look, lots of businesses get that math. I'll just use one example, movie theaters. Everybody knows movie theaters don't make money selling tickets, right? 87% of revenues for movie theaters come from selling high-priced popcorn and soda pop. Half of the people don't buy that. I like to laughingly say, we CFOs, I'm a former CFO, we CFOs, if we were running movie theaters, we'd charge $65 a ticket, and we wouldn't have many people coming in, right? But that way, everyone that did come in would meet our marginal revenue goals. They recognize that you make money, they produce revenue off of the margin, they accept the fact that half of the people are not going to buy the popcorn and pop. That's part of the business model. They accept that, and they make money along the way after they accept it. Very good. With that, I'm going to turn it over to Vicki.